What's the story of the intelligent investor? The intelligent investor provides valuable insights into investing, coming from the experienced perspective of Benjamin Graham. This trusted source, who thrived after the 1929 financial crash, shares sound advice on successful investing, drawing from the lessons he learned throughout his own career. The book serves as a guide for investors in navigating various financial environments. Who's the author of The Intelligent Investor? Benjamin Graham, 1884 to 1976, embarked on his investment career in 1914. Faced with significant losses during the economic crash of the 1920s, Graham learned valuable lessons that he compiled in his book, The Intelligent Investor. This work encapsulates the wisdom gained by Graham as a young investor, providing readers with insights into the principles of successful investing. Who's the Intelligent Investor summary for anyone fascinated by the dynamics of money and investments, and for those wishing to learn how to maximize their power to their greatest benefit. Why read the Intelligent Investor summary? If you've contemplated entering the stock market but were deterred by financial crises and market crashes, intelligent investing might be the solution. Introduced by Benjamin Graham in 1949, this approach involves a longer-term, risk-averse strategy that has proven successful over time. These insights, drawn from Graham's original advice and journalist Jason Zweig's comments, guide you on the path to becoming an intelligent investor. Throughout the following summaries, you'll discover the importance of ignoring market fluctuations, the benefits of starting your investment journey with virtual money, and the value hidden in seemingly inexpensive stocks. The Intelligent Investor Lessons. Keycap 1: Profits over excitement. Intelligent investors don't rush in, they take time to rationally examine a company's long-term value. Investing offers significant opportunities for financial gain, but it also comes with substantial risks. Throughout financial history, stories abound of investors, like Warren Buffett, who amassed considerable wealth by choosing the right companies. Equally prevalent are tales of misfortune, where individuals made ill-fated investment decisions and lost everything. So, is the potential reward of investing worth the associated risks? The answer is affirmative, provided you adhere to the principles of intelligent investing. Intelligent investors employ thorough analyses to secure safe and steady returns. This approach stands in stark contrast to speculation, where investors chase short-term gains driven by market fluctuations. Speculation is inherently risky because predicting the future is an uncertain endeavor. For instance, a speculator might act upon a rumor about Apple releasing a groundbreaking product, investing heavily in Apple stocks. If the rumor pans out, they profit; if not, significant losses loom. In contrast, intelligent investors emphasize pricing. They purchase stocks only when the price is below the intrinsic value, the value associated with a company's growth potential. As an intelligent investor, you'll only buy a stock if you believe there's a reasonable margin between your purchase price and the anticipated earnings as the company grows. This margin of safety is akin to prudent shopping. Just like buying an expensive dress is justified only if its quality ensures longevity, investing in a stock is sensible when the expected returns outweigh the purchase cost. The life of an intelligent investor may lack excitement, but the ultimate goal is profit. Keycap 2: Safe and steady over quick riches. Intelligent investors adhere to three fundamental principles. Firstly, before purchasing any stock, intelligent investors meticulously analyze the long-term development and business principles of the target companies. A stock's enduring value is intricately tied to the performance of the underlying company. Therefore, it is crucial to evaluate the company's financial structure, the quality of its management, and its history of paying consistent dividends, profits distributed to investors. Resist the temptation of fixating on short-term earnings. Instead, focus on the broader context by examining the company's financial history. These steps provide insights into the company's performance independent of its current market value. For example, a less popular company with a low share price but a consistent record of profitability may be undervalued, presenting a prudent investment opportunity. Secondly, intelligent investors safeguard themselves against significant losses by diversifying their investments. Avoid the risk of putting all your funds into a single stock, no matter how promising it may seem. Consider the distress if the seemingly promising company in which you invested heavily becomes embroiled in a tax fraud scandal, leading to an immediate loss of your investment's value. Diversification ensures that you won't lose everything in one fell swoop. Finally, intelligent investors recognize that their goal is not extraordinary profits, but rather safe and steady revenues. The objective for the intelligent investor is to meet personal needs rather than outperform professional stockbrokers on Wall Street. Trying to surpass those who trade for a living is impractical, and the pursuit of quick riches can lead to greed and recklessness. Keycap 3: Stock market history is important. Before delving into a stock's history, the first crucial step in investing is to explore the history of the stock market itself. A retrospective analysis of stock market history reveals its inherent cyclical nature, marked by regular ups and downs. The unpredictability of market fluctuations necessitates investor preparedness, both financially and psychologically. Economic crises, such as the Wall Street crash in 1929, are recurring events. Therefore, it is imperative to build resilience, ensuring a diverse stock portfolio to mitigate the impact of potential losses. Psychological readiness is equally vital. Resist the urge to hastily sell all investments at the first sign of danger. Instead, bear in mind that, even after severe crashes, the market has consistently rebounded. While predicting every crisis is impossible, studying the market's historical trends provides insights into its stability. Once market stability is established, shift focus to the history of the specific company in consideration. Examine the correlation between the stock price and the company's earnings and dividends over the past decade. Additionally, factor in the inflation rate to assess the actual return on investment, considering the general rise in prices. For instance, if you project a 7% return on investment within a year but face a 4% inflation rate, your actual return reduces to 3%. Evaluate whether the effort is worthwhile for a mere 3% return. In the realm of astute trading, historical knowledge serves as a potent weapon. Sharpen this tool to navigate the complexities of the market effectively. Keycap 4: Don't follow the herd. Don't trust the crowd or the market. To decipher the unpredictable nature of the market, envision it as a person. Let's call him Mr. Market. Mr. Market is erratic, moody, and not particularly astute. Easily influenced, Mr. Market experiences significant mood swings, oscillating between unsustainable optimism and unjustified pessimism. This is evident when the market reacts exuberantly to events like the release of a new iPhone, causing prices to surge due to heightened excitement. During periods of excessive optimism about future growth, stock prices become inflated, leading to potential overpayment. Conversely, when pessimism dominates, caution is warranted, and selling under unwarranted circumstances may be advisable. The intelligent investor refrains from succumbing to the crowd mentality and disregards Mr. Market's emotional fluctuations. It's crucial to recognize that Mr. Market's happiness may paint an exaggerated picture of future profits that might not materialize. A stock's momentary profitability doesn't guarantee sustained success. In fact, well-performing stocks often face the risk of losing value in the near future as demand inflates prices to unsustainable levels. Despite this awareness, the allure of short-term gains can be enticing. Human evolution has ingrained in us a propensity to recognize patterns, especially those promising favorable outcomes. Even when psychologists present random sequences and explicitly state the absence of a pattern, individuals still attempt to identify one. Similarly, witnessing continuous profit growth may lead investors to perceive a pattern that they believe will persist. At this point, you have grasped the fundamental tenets of intelligent investing. Subsequent insights will furnish you with practical investment tips tailored to your distinctive investment style. Keycap 6: Follow the defensive investor formula. Investing is easy when you follow the formula. After selecting the companies you wish to invest in, it's time for a well-deserved pat on the back. The bulk of your work is now done. Your focus shifts to determining the regular investment amount and periodically checking your stocks. Enter the world of formula investing, a method where you strictly adhere to a predefined formula dictating the frequency and amount of your investments. This approach, also known as dollar cost averaging, Involves investing a consistent sum in a chosen common stock every month or quarter. Once you've identified a secure stock, set your investments on autopilot. Commit to a specific amount, say $50, and invest it at regular intervals, buying as many stocks as possible for that fixed amount. The advantage is clear: minimal effort is required, preventing overinvestment and steering clear of risky endeavors. However, the emotional demands of formula investing pose a challenge. Even if your target stock is exceptionally attractive at a given moment, you've committed to sticking to your predetermined limit. Despite this, periodic checks are crucial for defensive investors to ensure the ongoing health of their investment portfolios. A handy rule is to reassess your portfolio's common stocks to bonds ratio every 6 months. Ask yourself, are my stocks still profitable? Does the ratio align with my initial investment distribution, e.g., 50-50? Additionally, seek professional advice annually to discuss potential adjustments to your funds. Armed with this knowledge, you are now equipped to kickstart your journey as a defensive investor. Subsequent insights will unravel the strategies essential for becoming a successful enterprising investor. Keycap 7 Enterprise investors start as defensive investors. Becoming a successful enterprising investor involves employing many of the same strategies as defensive investors. Similar to a defensive investor, you will allocate your funds between bonds and common stocks. While the defensive investor often opts for a 50-50 split between stocks and bonds, the enterprising investor leans more towards common stocks, acknowledging their higher profitability despite increased risk. Like the defensive investor, enterprising investors should also seek advice from a financial planner. However, the enterprising investor views their financial planner not as a sole authority, but as a collaborative partner in managing their money. Decisions are made jointly, with both parties actively contributing. In addition to using bonds and common stocks as the foundation of their portfolios, enterprising investors venture into other types of stocks with higher risk and higher reward. For instance, you might come across a promising startup that could be the next Google. While it presents an exciting opportunity, as an enterprising investor, you can take a calculated risk on this company, but only with a limited portion of your money. Regardless of how enticing an investment opportunity appears, enterprising investors should restrict such stocks to a maximum of 10% of their overall portfolio. Remember, intelligent investors are not infallible, and the unpredictable nature of Mr. Market sometimes defies rational predictions. Hence, setting limits is essential to safeguard your money in case of economic downturns or poor investments. Like defensive investors, enterprising investors understand the importance of ongoing research and monitoring to sustain a consistent flow of incoming profits. Keycap 8 Enterprise investors don't copy the market. When you own stocks and their prices fall, do you immediately sell or hold on to them? If another stock is on the rise, is it wise to join the trend before it's too late? This common market-centric approach, driven by fear of potential financial losses, characterizes many investors. However, an intelligent investor knows better. Relying on Mr. Market's whims is risky. If a stock's prices are rapidly increasing, it's likely either already overpriced compared to its intrinsic value or involves a risky investment. Reflect on the U.S. housing bubble a few years ago. Despite escalating prices, many failed to realize that they no longer represented the true value of properties. When this reality became undeniable, the entire market collapsed. To avoid such scenarios, enterprising investors adopt a strategy of buying in low markets and selling in high markets. Regularly assess your portfolio and scrutinize the companies you've invested in. Ask questions like, is the management still performing well? What is the current financial situation? Upon recognizing that a company in your portfolio is overrated, with stock prices growing disconnected from its true value, it's prudent to sell before an impending crash. Conversely, seek opportunities to buy in low markets. An example is Yahoo! Inc.'s 2002 acquisition of Inktomi Corporation for a mere $1.65 per share. This was an exceptional bargain, as Mr. Market had become pessimistic after Inktomi's shares plummeted from the significantly overrated $231.625 per share during a period when the company was unprofitable. Backhand index pointing right. Discover more. An open letter to my future son and daughter, Step 2. An open letter to my future son and daughter, Step 1. An open letter to my future son and daughter, Intro. Keycap 9. Enterprise investors need to hunt for bargains. Becoming an enterprising investor may seem like a rewarding challenge, but is it truly worth the effort of constantly monitoring your portfolio? Indeed, it is, as this is where the best bargains often lie, but only if you start with a strategic approach. A smart way to commence your journey as an enterprising investor is by virtually tracking and selecting stocks. Engage in virtual investments for 1 year to refine your ability to identify bargains and monitor your stock's progress. Numerous websites now offer the opportunity for virtual investments. Simply register to determine if you can achieve results better than the average. This 1-year practice period serves multiple purposes. Not only does it aid in learning the intricacies of investment, but it also helps manage fantastical expectations. After completing a year of virtual experience, you'll be ready to embark on the journey of bargain hunting. The prime location to find bargains is in the stocks of undervalued companies. Typically, the market undervalues stocks of companies that are either temporarily unpopular or undergoing economic losses. Consider this scenario. Enterprise B, the second strongest competitor in the refrigerator market, is a large company with consistently sound, though not spectacular, profits over the past 7 years. Due to a recent production error, however, the company's profitability has declined in the last 2 months, causing its share price to plummet as nervous investors react. Once the production error is resolved, the company will likely return to its previous state, and an intelligent investor would view the declining prices as an opportunity to secure a great bargain. Identifying bargains can be challenging, emphasizing the importance of getting a year's worth of practice first. If you can navigate the virtual world successfully, you'll be better equipped for real-life investing. The Intelligent Investor Review. The fundamental message of the Intelligent Investor Summary is clear: whether adopting a defensive or entrepreneurial approach to stocks, the path of the intelligent investor leads to success. By adhering to the guidelines presented in the Intelligent Investor Summary, individuals can transform their investments into consistent and steady profits. The strategies outlined, such as thorough analysis, diversification, and a long-term perspective, offer valuable insights for those seeking to navigate the complex world of investing intelligently. The Intelligent Investor quotes. Benjamin Graham quotes, "The intelligent investor is a realist who sells to optimists and buys from pessimists. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Those who do not remember the past are condemned to repeat it." An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. But investing isn't about beating others at their game. It's about controlling yourself at your own game. The stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analysis are right. People who invest make money for themselves. People who speculate make money for their brokers. As the Danish philosopher Søren Kierkegaard noted, life can only be understood backward, but it must be lived forwards. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dundee, you will be much more in control if you realize how much you are not in control. Invest only if you would be comfortable owning a stock even if you had no way of knowing its daily share price. And back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. You must thoroughly analyze a company and the soundness of its underlying businesses before you buy its stock. A stock is not just a ticker symbol or an electronic blip, it is an ownership interest in an actual business, with an underlying value that does not depend on its share price. Plant trees that other men will sit under. Buy cheap and sell dear.